In August of 1928, the Dow Jones Industrial Average began to accelerate higher, breaking out above a trading range that it had been trading in for the year before. This breakout was then followed by a 63% move higher on the stock market, providing spectacular returns for investors over the year that followed. Of course, we know what came next. The drop that occurred on Black Tuesday in October of 1929 wiped out the entirety of that rally in a single day, and that set off a bear market, taking the Dow Jones down 89% over the next 3 years. Fast forward to October of 2006, and we see the exact same thing happen. A breakout above a key price range that the stock market had been trading in over the last year was followed by an additional 15% upside over the next year, but eventually led to the most painful market drawdown since the Great Depression. Fast forward to today, and the stock market has also broken out above a key trading range that it respected throughout 2023. Very similar behavior to what we saw in October of 2006 and August of 1928. Today, we're going to be diving into history to understand exactly what this breakout means and whether we should be concerned about it looking like 2006 and 1928. In 1989, we have another example of the exact same thing happening, where the stock market accelerated higher, breaking through its prior trend, which was followed by another year of the market rising by 20%. But ultimately, a recession occurred in 1990, bringing the stock market back down below the level where the breakout occurred. Again, in 1980, we have the same story. We have the market breaking out above a key trading range in the short term that led to an additional 15% upside on the S&P 500 before ultimately a recession followed, causing all of these stock market gains to be wiped out over the course of the next 2 years. All of these breakouts that we've taken a look at so far, 2006, 1989, 1980, 1929, all of them were pretty good buying opportunities in the short term. The stock market breaking out led to further upside in the months that followed. Over the long run, however, in all 4 of these cases, the stock market ended up suffering within the next year from a recessionary downturn. So right off the bat, we can conclude that these types of signals of market strength don't necessarily mean that we're heading into a perfect economic environment. Quite the contrary, it shows us that you can see this type of market strength right before severe economic downturns. But thankfully, not all of them do. If we go back to May of 1995, we also saw this type of big breakout on the S&P 500 above a key price range. This was followed by spectacular performance in the near term, but it actually led to a spectacular 5-year bull market, and the level at which the S&P 500 broke out was never revisited again. So this was an incredible opportunity to buy stocks both in the short term and the longer term. This also happened in 1987. We saw the stock market break out, which led to a massive rally over the course of the next year. Of course, you eventually had the Black Monday crash that led to a rapid 30% drop in the stock market, but it never actually came back down to the same level at which the breakout occurred. So you could say that this was both a successful short-term buy signal for the market and a great long-term one as well, if you were willing to weather through some volatility. And we can again say the same thing about 2013. This breakout that you see right here was never revisited. It led to both short-term upside on the stock market and long-term upside. So what we can say about these episodes, 2013, 1995, and 1987, is that when these breakouts occur and no recession follows, you get both great short-term and long-term returns. For now, what's clear about these types of breakouts is that they almost systematically lead to short-term upside, at least from the 7 episodes that we've looked at so far. But there are exceptions. In December 2019, the stock market broke out above a key trading range, just like in all of these episodes. But you can see in the couple of months that followed, the breakout was completely reversed. We all know what began in February of 2020. The pandemic stopped this rally dead in its tracks. So although we'll never know for sure what would have happened to the stock market without a pandemic, we can see that when there's a surprise event, it can quickly reverse a breakout, and then that becomes what's known as a false breakout, And as you can see from this chart, it's a very bearish development. We saw the exact same thing happen in November of 1972, where the stock market broke out above its trading range. Within the next couple of months, the market rally reversed, making this a false breakout and setting off the beginning of a 50% drawdown in the stock market. We haven't found many of these types of false breakouts throughout history. 2019 and 1972 are the only examples, but it shows us nothing is a guarantee in financial markets. And even beautiful breakouts in the market can fail and lead to poor short-term returns. Today, the stock market is not immune to that type of event. With geopolitical tensions rising in the Middle East, if oil prices break out and trigger another oil shock, higher oil would mean higher inflation and a lower stock market. This isn't our base case, but it could happen. From all of the episodes that we've taken a look at in this video, all except 2 of the breakouts were successful for the short term. So in 2024, we're betting that that's going to be the case again, but you can see over the long run, many of that short-term upside we saw in the stock market was completely reversed and associated with a recession. And one aspect that we think is very important today is that the yield curve is inverted. And when we look at all of the breakouts on this list that also occurred with a yield curve inversion, we have 2006, 1989, 1980, 1929, and 2019. While most of them had great short-term returns, all of them ended up leading to a recession. We've so far gotten this correction on the S&P 500 spot on. The final target that we laid out for our members at Game of Trades was hit beautifully, and the S&P has so far bounced right off. We were able to add equity exposure at the very bottom of that move, and we also think there's going to be some more volatility in the coming days, so we'll be using that as an opportunity to continue adding some of our favorite setups on the market that we think have the most amount of upside in the coming months. Patience in the stock market is rewarded. If you FOMO'd into the market at the peak, you're now in a lot of pain. Buying after the market has corrected by 5-6% makes the risk reward of your trades significantly more attractive. Now, also as a big disclaimer, if this support structure doesn't hold, that would make this a false breakout, just like 2019 and 1972. And as we've seen, false breakouts are very bad news for the stock market. So we're following these structures very carefully at gameoftrades.net.